Hey guys, welcome back to Sensor Sense. My name is Evan, and today I come to you and I want to discuss the stock market and some things that I've found a bit disturbing, as well as an article that I found in the Wall Street Journal this week about how a majority of the gains in the overall stock market are related to one stock. Can you guess which stock? If you said Nvidia, you were right. The hype is real under Nvidia, I understand that, but when it starts accounting for a large chunk of the gains in a major market like the SP 500, it spells doom for the rest of the market, because the instant it starts to turn, or AI loses some of its luster, or Nvidia loses some of its luster, has a bad quarter, has some negative publicity, whatever the situation may be, the whole market's going to suffer. And so what I wanted to talk to you guys all today about is an article. The article here, let me pull it up and take a look at it with you. It's entitled, "Nvidia's Success is the Stock Market's Problem. The market is overly reliant on the chip company, which on its own accounted for a third of this month's gain in the S&P 500. You see why that's a problem? There are 500 stocks in the S&P 500, and one of them accounts for 33%, or roughly thereof, the gain in the stock market. That means that the other 2/3 of the gain comes from the other 499 stocks. And actually, I'll tell you, as I did in one of my previous videos, it's about 20 to maybe 50 of those remaining 499 that make up the rest of that. And that's another issue. There's not what they call breadth in the market. So it's a very narrow market. Not a lot of things are moving it. What that means is when the market decides that it's going to turn quickly. And I've seen this year after year for over 25 years of being in the industry. It's also the summertime right now, and during the summer we have these pullbacks in the market. And if Nvidia starts to pull back, which it looks like it has yesterday and today, we're going to have some issues with this market. Let me go on to read some more of this to you. "It was the best times, it was the worst times, but some pretty bad times. In the tale of the two stock markets facing U.S. investors, the S&P 500 is soaring to new records driven by a single company, Nvidia, while less important companies fall and remain far below their highs. The Russell 2000 index of smaller companies is down 17% from its November 2021 peak, and has made no progress at all this year." And this is something I've talked about in one of my previous videos as well. The smaller companies out there are suffering terribly because of interest rates right now. We cannot reduce our interest rates in this country until we get our inflation completely under control. The Federal Reserve has said they're not going to lower interest rates until, well into 2025. We might get one rate cut this year, maybe two, but I highly doubt that. Significant decreases in interest rates are not going to happen this year. And until then, we're not going to get the small caps to participate. So going on with the article, it says the S&P, which includes the biggest companies, the average stock is about where it was at the start of 2022, and more than half of the current constituents are down since then. Worse still, only 198 have managed gains this month, even as the index has reached new intraday highs on 11 of the 13 trading days. That's a really critical point. So let's talk about that. 198 have managed to make gains this month, but 302 have not made gains. It also says the average stock is about where it was at the start of 2022. This is not good. This tells you again that the market is very narrow. Some larger companies like Nvidia, Apple, and the likes are making up a majority of the gains in the market. This is not good for long-term investors. So let's continue on. "The narrowing of the market is prompting concern among technical analysts who think broad gains by lots of stocks, so-called breadth, make a bull market more sustainable." So that's what we've already talked about. If you don't have the broadening of the market and all the other stocks in the market that are helping out push the market higher, then it's not going to create a sustainably high market for very long. In fact, going on with the article, what it indicates is that there are two different things pushing stocks around: demand for chips to drive artificial intelligence, and concerns about the economy and interest rates. It's exactly what we've talked about in the past videos. Interest rates, and AI on the other side. Somehow AI is winning this battle. I don't think that can continue on forever. These stocks are way up, especially Nvidia, and some similar stocks are up tremendously. They're going to have to taper off and come back down to earth. The first has led Nvidia and a handful of other stocks in the market as a whole to new highs and made Nvidia the world's most valuable company as a couple of days ago. The second has pushed most stocks down as weak data lowers expectations for growth while the Fed continues to worry about inflation. I agree that in the case, the lack of broad gains puts the rally at risk, but for a different reason than some might think. My worry is that the market is overly reliant on just one stock, Nvidia, which has on its own accounted for a third of this month's S&P. Thursday's pullback in 44% of the gains since the start of 2022. So 44% of all the S&P 500's gains has been due to one stock out of the 500. That's kind of crazy to me. If Nvidia stops performing because demand for chips weakens, because AI hype runs out, or simply because everyone already owns it, the index would be reliant on the rest of the market, and the rest of the market is much less solid. So there's the issue again with the market breadth not being there. Investors buy the S&P through cheap and popular index ETFs because they want to spread their exposure across lots of companies. At the moment, they are buying a lot of Nvidia specific and broader AI risk. That has worked out so far, but the AI race has led to extraordinary demand for Nvidia chips, but the S&P is doing a lot less to diversify risk than it used to. In fact, it goes on, it says that the rest of the market could step up if Nvidia stalls, but other stocks boosted by AI are unlikely to help. Nvidia is now so big that it falls in its shares can drag down a market that otherwise would have been fine. So this is another issue. When we become too reliant on one stock like Nvidia and it starts to go down, the market is going to go down much more precipitously than it has in the past. In fact, the narrow market, it has a chart here that talks about the narrow market, the S&P equal weight. So if you look at each company based on its actual market capitalization instead of just being one of 500 companies in the market, is basically flat on the year. While the S&P 500 itself is up about 14 to 15%, and the Russell is down between about 12 to 15% over that same time period since 2022. This is just a classic example of a overhyped market that we're in. We've seen this back in 2000 with tech stocks. That was a huge crash after that. We saw it in 2008 and 2009 with housing and finance stocks. That was a massive crash. We've seen other smaller ones over the past in 2018, also very problematic. It goes on, the article says, the trouble here is that investors are growing concerned about growth while worrying about the Fed won't cut quickly enough to help out. But bond yields have been coming down, with the rate-sensitive 2-year yield going down from 5.1% at the beginning of April to 4.7%. But traders have all given up on the rate cuts coming both next month and in September, as Fed officials caution they need more evidence that inflation's heading towards their target. So to compound this matter, guys, we have no market breadth. We have a very narrow market. We have a Federal Reserve who's basically not loosening their tightness on the market, which means that interest rates are not going to fall significantly in the near term. And that spells a lot of problems. You combine that with increasing joblessness and slower economy, and this is leading to a potentially disastrous situation going into 2025. That has led to a switch in behavior by smaller stocks in the S&P this month. Instead of being buoyed by lower bond yields, the average stock fell as bond yields fell as well. Even the tiddlers of the Russell 2000, which tend to have more debt and thus tend to be more sensitive to yields, didn't benefit. A weaker economy without much in the way of rate cuts isn't a nice prospect for investors at a time when high rates are already hurting low-income consumers and smaller and weaker companies. There you go. There's a summary. Let me say that again. A weaker economy without much in the way of rate cuts isn't a nice prospect for investors at a time when high rates are already hurting low-income consumers and smaller and weaker companies. That describes pretty much what you need to know. The good news is the market is fickle. It could easily switch from worrying about a weak economy back to thinking growth is strong, particularly since the latest data has been mixed. It goes on, and that's pretty much the end of the article. But again, I'm going to say this one last time. This market is very narrow. It needs to broaden out. Other stocks need to lead the marketplace here. We have a problem with interest rates being too high for too long. The Federal Reserve is not going to help us out this year. This is an issue. Nvidia cannot continue to lead in order for our markets to stay high. That's the bottom line. We have to have a stronger market. I don't think that's going to happen until we get further into late 2024, maybe into 2025. At any rate, I want to leave it at that today, guys. I find that this market needs some additional help. I'd love to hear what you guys have to say about it. Again, my name is Evan. This is Sense or Sense. Be sure to hit that like button, subscribe, hit the notification bell. I want to bring you more videos like this, and I'll see you soon. Thanks.